Hello, I'm Sean Richards of Not a Yes Man's Economics, and what I want to talk to you about today is negative interest rates. Now, just as an explainer, what do I mean by that? It does actually mean that, to say put money at the bank could end up costing you. Or, in an extreme case, people could be paid to borrow. Now, that's not as extreme as you might think, because, for example, countries like Germany and Switzerland, these are the headline cases, are in fact being paid to borrow. That might seem insane if you haven't followed this, because why are people doing that? Well, they are, and that's part of economic life at the minute anyway. If we come back for a moment and look at the issue of negative interest rates, so this has been a specialist area of mine, and I own up that when I was standing in the futures pit, specialising in, guess what, short-term interest rates, we had a long discussion on this about 20 years ago and decided it couldn't happen. So now, fast forward to where we are, it has happened across a lot of Europe, Japan, and one or two flickers in other places. But how does this sort of go forward? Well, to my mind, there's a push from the establishment and central banks for more of this. They have problems. After all, why are we still discussing the credit crunch a decade after it? The reason is that there are still problems around, and central banks are afraid of another recession. We've flickered through 2019 with that fear about, particularly in Europe, less so in the United States. But the trade war issue has brought that back into focus a bit. Why? Well, if we now look at the United States, we saw quite a few interest rate cuts, and it's now 1.5 to 1 3/4. But if it starts cutting, we then come to the next bit. What if the United States goes to negative interest rates as well? That'll have an impact on the rest of the world via the US dollar. A lot of demand for US dollars. How does all that work? And we find that the former chair of the US Federal Reserve, Ben Bernanke, was talking about this over the weekend. One of the ways forward for expansionary monetary policy would be for US interest rates to go negative, according to him. Of course, what that never really answers is why we always need more of everything. We were supposed to be fixed by lower interest rates, weren't we? Then we were supposed to be fixed by the quantitative easing bond buying, and so on. We've seen loads of this. But coming back to the issue, this poses a lot of questions. For example, in places where negative interest rates are right now, the banks have been very afraid of passing that on to the ordinary person. If we look at Germany, it is sort of been a test case, if you like, an example, then institutional savings and those with a lot of money have seen negative interest rates, but the ordinary saver so far has mostly avoided it. The banks are afraid people will take their money out. And this then poses a problem of how it's going to fix things. For a start, and here's an irony for you, so much of this policy was supposedly to help the banks. For the reasons I just described, banks are actually been hurt by negative interest rates. They pay it to the central bank, but they're getting it sort of quite hard to get it out of the ordinary person. And that's a problem here, because then how would it boost the economy? But this doesn't seem to stop advocates of this sort of thing wanting it. If it really came in force, then for an example, what if people took their money out of the banks completely? Now, on a large scale, that probably wouldn't be happening because it would stop, but people might take it out. And so here we come to a situation whereby we become used through our lives to have actual interest rates on things. Could that stop? What does it mean? And what sort of world are we in? Personally, I think it would be much better if the banks change course. But we're potentially facing a future where even the United States might end up with, say, I don't know, interest rate of what? -1%? Thank you.